Inflation is key to watch, but as Bloomberg has decided to suggest, there are two ways to look at inflation: the fake CPI and the fake core PCE rate, both intentionally used to obscure the real rate of rising prices. Somehow, we have seen many investors fall in line with this belief and yet encourage the actions of the Fed, which is, of course, the definition of inflation, the expansion of the money supply. But no worries, the Fed will just print more money to fix whatever problem happens, right? You came here for the truth, so let me unveil that for you. Today, we're going to look at what's happening in the markets. We're going to talk about the economy. I've got a lot of information. You're seeing what happens in all of these bull markets where the euphoria gets so hot that essentially nobody is left on the other side of the trade. And there's always two sides to a trade. And this disparity usually comes around and you have corrections. That's, let's say, a few percent, maybe 10%, technically 10%, a correction in the markets. You see that it gets even crazier sometimes, going into a bear market, 20%. But there are other times where we have a full-blown crash. And those are usually at the peak hysteria and euphoria and mania. Are we there yet? Well, certainly the Federal Reserve does not think so. Certainly the markets and the investors, the institutions, they don't think so. But you as an individual need to monitor what you're doing and how all of the different assets that you have are behaving. And if they're getting too hot and too heavy, you've got to start wondering, where is the best place for my money right now? Does that mean I take a little bit off the top and put it in somewhere that is a little underappreciated at this time? Do I keep it in cash? These are all questions. If you want to check out some of the other videos I have done to give you some insight on that, check the previous video and the one before that. And there's a lot of detail. I'll link to one of those at the end of this one. I've got a lot of detail here. Let's go. So you saw the initial image there, and I said the Fed spooked the markets, but if you take a look at this, day after day after day in the green. So what's going on with this precisely? And by the way, this, you could see that the market had actually gone down on Monday's trading session, but you look at it on Tuesday and we'll see what happens there. But all I wanted to note from this was that you haven't seen a time like this when it's day after day after day since 2013, if I'm not mistaken. Just showing you the euphoria and the fact that there's nothing that could bring this market down. At least that's what they're telling you. Amid new highs, it's not surprising for the market to be moving somewhat in a holding pattern of late. All eyes will be on the CPI read tomorrow. By the time you're watching this, it's probably today, for a benchmark on where we stand on the inflation front. Oh, that's right, because they're going to tell you the real rate of inflation, right? So by the time you're watching this report is going to be out. And let's be honest, it doesn't matter what that report says. It's not going to be the real rate of inflation, but the market is certainly going to react to it. And then we've got the Federal Reserve coming out every few days. One of the different presidents or one of the high-level people starts to put these messages out there. They call it forward guidance that essentially tells the markets that everything is going to be okay. But one individual said something interesting, so we'll talk about that in a few minutes, but I need to show you some other stuff first. This comes from Bloomberg. Is the CPI the only figure that matters? And I thought to myself, wow, they're going to talk about other forms of, measurement of inflation, and so this should be very interesting. No. Economists often look at the core measure, or the CPI index minus food and energy, categories that tend to be volatile, like as if it's a copy and paste from their propaganda. The core CPI, it goes on, and there's also the personal consumption expenditures price index. You know it as the core PCE rate that the Federal Reserve loves to use. Right here, you can see they mention it as well. Now, the core PCE rate, the last time I had checked, was 1.4%, and I'm seeing that they're referencing 1.6. Anyway, the number is extremely low, extremely low. So these rates do not actually measure what they are here to supposedly do. Is it the personal consumption expenditure? And it's 1.4, 1.6? I mean, personal consumption expenditure, and yet nobody is experiencing that rate. So it is intentionally being used to manipulate the real rates, and this is to obscure their activities. What they have been doing, not just the Federal Reserve, of course, but the government has been really, all of them are doing the same thing, and that is to expand the debt, expand the deficits, and essentially weaken the currency. U.S. budget deficit widened to a record $1.7 trillion for 6 months as stimulus checks fueled the spending. Gap brought into $660 billion in March alone as spending surged amid the payouts. The expectation for the deficit this budget year will total $3.3 trillion, an all-time high, but up just 6.5% from last year's record shortfall of $3.1 trillion. I just have one big question. How in the world are they going to pay for it? Well, they say they're going to tax the rich. They say that they're going to tax the corporations. But they promise that they won't tax you. You think that's true? You can see it in the chart form right here, cumulative fiscal budget deficit. And the red line obviously is 2021, heading into the deep, dark territory this year. Investors have put more money into stocks in the last 5 months than the previous 12 years combined. That is a big one. I mean, you got to think about this. They keep telling you there's so much money on the sidelines. There's all this pent-up savings that people need to spend. Look at where the money is going. I think it's very clear. A few charts here just showing you what's happening. And you can look at the RSI, which essentially shows us how overdone or underdone a particular index or stock or what have you. It just gives you some insight as to when you hit these peaks, when you hit these troughs, how the market is reacting to it. And right now you can see that it looks as if we are entering a similar pattern to what was experienced back in September. Does that necessarily mean that things are going to change? No, but when it gets in this territory, it looks like over 83 right now on the RSI, which is, of course, quite high. And generally, there's a correction. In that case, it was over 10%. So you're looking at another potential time frame for at least some sideways action for the next while. It depends on the news that comes out. It depends on how investors react to inflation. You could have more because of that fear that, oh my goodness, the dollar is going to lose value, so we're going to put even more in. But usually the technical indicators happen to signal what we already know. And if something is overbought, then usually, you got things that shift around and it brings the markets down temporarily, of course, because the way that things are, it looks like it just continues to go up and up. Here's the price to sales ratio going, in a direction that we've never seen anything like this before, far greater than, of course, the financial crisis and well beyond what we had seen during the dot-com bubble. And then we have the Wilshire 5000 to GDP ratio skyrocketing far past the previous two bubbles. The Fed's bullard is generally the most bullish of all of the members of the Federal Reserve. And I think it's quite interesting. His name has the word bull in it. But this is what he said. It's too early to talk about changing monetary policy. We want to stay with our very easy monetary policy until we are still, while we are still right now in this time frame that concerns the governments. If we get to the end of this tunnel, it will be the time to start assessing where we want to go next. Extremely vague language there, but essentially just saying, we're going to make sure everything's totally fine before we change all of the different policies. However, they did mention something that is quite useful. When you start to get 75% or 80% of the people that get the different things from Pfizer and J&J and Moderna and AstraZeneca and all that, I'm probably not allowed to say, it's a trigger word, and the CDC starts to give more hopeful messages that we are bringing this under better control and starts relaxing some of their guidelines, then I think the whole economy will gain confidence from that. And essentially what he says in here is that at this point, we will then start to discuss a tapering. Now that right there worried the markets big time, because this is so key. It's so integral to what's happening today. Watch very closely as the market reacts to this information in the coming days and the coming weeks. This time frame is literally, according to the CDC, it is approximately 2 months away, the 75% number. So that would be huge. That would be huge to see if they even mention a word of a taper. That would spook the markets. So we will be paying close attention. A little bit of humor for you. I wanted to bring up the BLS website. I didn't realize this. I didn't catch it at the time it came out, but the U3 unemployment rate has fallen down to 6%. That's right. No, not a joke. I'm on the BLS website right now. The U3 unemployment rate at 6%. I'm going to show you some charts that go in line with that, and you could see for yourself. Take a look at this one from Real Investment Advice. The U3 unemployment rate. That's the orange line. And then you have the participation rate adjusted U3. So once you include that information into it, it looks like it's 13%. Then you have this, not in the labor force. We're talking about 100 million people that are not in the labor force today. That should give you some pause. That should make you realize something very strange is going on when the numbers that they show us give us 6% unemployment numbers, and it's not really adding up. It's not adding up. What's the problem here? They're not going to tell you. Come on, let's go. Okay, now this one, I'm not going to even bother trying to pronounce that, but this is the employment index. I've shown you this before. Depending how you break it down, non-employment index, including people working part-time for economic reasons and so on. Look at the different measurements: 6.2%, 9.2%, 10.4%. You could look at shadow stats. They have their own calculations. The point is the 6.0 number is not accurate. Couple quick notes right here. You can see the manufacturing jobs around recessions. Today, that's the black line, and the mean, as you can see in the red, it's quite frankly something that is going slower than they told everybody it would be. But I think the problem here is long term for manufacturing, and that quite frankly, they are not going to come back. US real personal incomes, you can see that it has been falling since October. But you look at what's happening with the government pumping in all the money, it changes everybody's perspective on that information. But we have to look at the real data, and that's why I bring it to you here. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. I did a video yesterday. I'll link to it in just a second. My worst performing video of the last, I don't know, even a few years. But yet I got so much such a positive response from it. You definitely want to check it out. I wanted to let you know that I got a reply from Nomad Capitalist's personal assistant, asked some follow-up questions. Potentially we could see an interview, and that would be the first of a series of interviews that I want to do. So definitely I've got some recommendations for people have told me who they want to see on, so I'll definitely work on that. I also wanted to let you know, people who are trying to get into Clubhouse, I get three invites every I think it's every week or so. I'm letting in 3 people, but there's like 7 people who have received invites that have never even accepted them. So I don't know if there's some sort of communication problem. I've sent those people, you message me on Instagram, you go in the queue essentially, and as I get them, I'm replying to these people. 7 of those people have not replied. So that like you take up those invites essentially. So I've got 7 wasted invites at this point. But anyway, if you want to get on Clubhouse, I've been on there almost every single day talking to people. So I would highly recommend checking that out. If you want the free e-course that I've got about e-commerce, the AmazonGPS.com. If you want to learn about the financial system, check out my 2 books. The link is in the description. And this is the video right here. I'm telling you, it's got such good information, terribly performing video. And I laugh at that because, those truly informative videos, a lot of people, they're just not watching it. And that's unfortunate. Definitely check it out. You can watch it at 2x if you have to. Click it and I'll see you there.